Hey everyone, welcome back to the channel. Today, we're diving into one of the most popular trading strategies, the Golden Cross. We'll break down what it is, how it works, and I'll show you how to backtest this strategy using real data. Let's get started. The Golden Cross is a technical analysis pattern that traders use to identify potential bullish trends in a stock or other asset. It occurs when a shorter-term moving average crosses above a longer-term moving average. Typically, we use the 50-day moving average and the 200-day moving average. When the 50-day MA crosses above the 200-day MA, it signals a potential buying opportunity. This crossover suggests that recent prices are trending upwards faster than the longer-term average, which can be a strong indicator of a bullish trend. You might be wondering, does this strategy actually work? The answer is, it depends. While the Golden Cross is a popular indicator, like any strategy, its effectiveness can vary based on market conditions and the asset being traded. To really understand how well it works, we need to backtest it. This involves running the strategy against historical data to see how it would have performed in the past. I've written a Flask app to backtest the Golden Cross strategy using real data. We're taking a closer look at our Flask app that backtests the Golden Cross strategy. We'll walk through how the app fetches historical stock data, calculates moving averages, and checks for Golden Cross signals. Plus, we'll show you how it analyzes stock performance and displays the results. Let's dive in. Here's a quick look at our Flask app. We've set up a few key endpoints to handle the different parts of our backtesting process. First, we have an endpoint to fetch historical stock data. You input the stock symbol in the test box, and the app retrieves the relevant price data next. The app calculates the 50-day and 200-day moving averages based on the fetch data. These averages are crucial for identifying the Golden Cross signal. When the 50-day moving average crosses above the 200-day moving average, the app records this event as a Golden Cross signal. Here, app tracks these crossover points and flags them as potential trading signals. Once we have the Golden Cross signals, the app analyzes how the stock performed after each crossover. Did the price go up as expected? Was there a strong trend following the signal? The app examines the stock's price movement post-crossover to evaluate the effectiveness of the strategy. Finally, the app displays all the trade details on the results page. This includes the profit or loss from each trade based on the Golden Cross signals. Here's the results page. It shows detailed information about each trade, including the entry and exit points, and the overall profit or loss. This comprehensive view helps us understand how well the Golden Cross strategy performed and whether it was profitable. I'm sharing the results from our backtesting of the Golden Cross strategy on 3 stocks, TCS, BSOFT, and BEL. We ran these tests over a 20-year period with an initial capital of 1 lakh. Let's dive into the results. Starting with BEL, unfortunately, the results weren't as positive. BEL ended up in an overall loss despite the Golden Cross signals. BEL didn't perform as well as expected, and the strategy didn't yield a profit. On a more positive note, TCS and BSOFT showed impressive results. Both stocks generated around 3 lakh in profit from our initial capital of 1 lakh. Results suggest that the Golden Cross strategy was effective for TCS and BSOFT, providing significant returns over the 20-year period. To sum up, while BEL did not perform well with the Golden Cross strategy, TCS and BSOFT yielded substantial profits. This highlights the variability in strategy performance across different stocks. If you're considering using the Golden Cross strategy, it's important to analyze each stock individually and consider the strategy's effectiveness in various market conditions. Backtesting over a long period, like 20 years, can show promising results. But it's important to remember, not every trade will be a winner. Even a good strategy can sometimes fail due to changing market conditions. Here, we see a mix of successful trades and some that didn't go as planned. So, how do we avoid these losing trades? The answer lies in combining the strategy with additional technical analysis. By using other indicators like moving averages or volume trends, we can filter out trades in uncertain market conditions. This helps avoid entering bad trades and increases the chances of success. With these extra layers of analysis, we reduce losses and improve overall profitability. Remember, no strategy works all the time. But with the right tools and techniques, you can make it work more often and more profitably.